right, what's up, guys? We always get nervous when we first start off in a new business and we're like, what am I doing? How do I write this? How do I know what to write? So we're going to break this down for you very simply. And if you need to watch this video 3 or 4 times, do that, right? Because the more we let that anxiety go, then the easier we're going to be able to learn this and actually be able to help some families. Okay. So a lot of it's in our heads and we overthink it too much. So I want you to break this down and think about there's only 2 policies, only 2 types of policies that we're trying to get a client into. There's a term that's full coverage and a whole life, which is full coverage. Just 2, term, whole life. You only have to decide on 2 products. That's it. Okay. So what's term? Term lasts a length of time. It lasts, you lock it in for 10 years or 15 or 20 or 30 years. After that, it's done. It's over with. No more protection. Price isn't locked in. You're done. Whole life lasts our whole life. Just like the word, lasts forever. Okay. So if there's a term, there's a chance that the client could outlive the term, right? There's about the average is about 93% of people outlive a term. Is that making sense, guys?
Yes.
So there's a 7% chance that the insurance company's gonna have to pay out on a term. Okay. So that's why it's cheap, right? They're like, okay, only 7% of these people I'm gonna have to pay out on. 93% of these people I get to keep their money, keep their premiums, and never have to pay a dime to the client. So term is always cheaper, right? What's the chance of someone dying in their whole life?
Definite.
100%, right? 100%. So the insurance company has to pay out 100% of whole life policies, okay? And they only have to pay out on 7% of term policies. Which one do they have to charge more money for?
Whole life.
Whole life, right? Because they had to pay out on every single policy, right? So whole life is more expensive. Okay, so term is cheaper, whole life is more expensive. Which one has the better guarantee? Which one's 100% guaranteed to pay out?
Whole life.
So you're paying more though for a guarantee. You're guaranteeing that your loved ones are going to collect some sort of money when you die. Is there a guarantee on a term policy? There's no guarantee, right?
No.
You could outlive it. You can outlive a term. Okay. So if we can outlive terms, then that's why it's cheaper, right? There's less risk for the insurance company, more risk for the clients, cheaper. Whole life's more expensive because it lasts forever. It's really the only insurance policy that's guaranteed is a whole life policy. You can buy car insurance, homeowners insurance, term insurance, accidental insurance, health insurance, you name it. Insurance out the wazoo. There's only one insurance policy that's guaranteed to pay out. That's a whole life policy. So there's only one thing that's guaranteed in life: whole life policies and death and taxes. I guess 3 things, right? So we know whole lives they're charged more because they're guaranteed to pay out. Okay. So when we're younger and we're healthy, we want to try to put people in terms because they can get more coverage for cheap. You have to be healthy to qualify for a term. What's one way we can tell if someone's unhealthy or healthy? You guys have any ideas?
Prescriptions.
Prescriptions, yes. If you need a lot of medications to stay alive, you're probably unhealthy, right? Right? Does that make sense?
Yeah.
Okay. If you don't need a lot of medications to stay alive, you're doing pretty okay. Now, if that one medication you're taking is for cancer, do you think you're healthy or unhealthy?
Unhealthy. Healthy.
Probably the insurance company's like, I don't know, this guy has cancer. So if it's like one medication for something extreme, like kidney disease or I don't know, something crazy, is like a bad health condition, probably don't try to go for term. So if you're not really sure what to write, what you can do, and what I did in the very beginning, if I don't know anything, you can start with Americo, and then you can fill out the application. And it will tell you when you get that first signature done, if they're approved or declined. So you can just say, hey, we're going to see what you can qualify here. Start filling out the app, start with a term. It's going to come back and say declined. And you're like, okay, term, that looks like they're not healthy enough for that one. Let me try a whole life now. And then you can start filling a whole life one. That's how you can tell easily without looking at any cheat sheets or anything, if they can qualify for a term or whole. So we start with term. If they seem kind of unhealthy, you should kind of know a general sense, like, there's some medications they're taking, it's kind of wacky. And you're like, I don't know, this doesn't seem like someone's really that healthy. Probably start with the whole life. They seem sort of healthy. You start with a term. The Miracle app's going to tell you right in the first signature process if they're declined, and hey, we're going to have to switch to something else here. We're going to try this next route because we got a decline on this one. And then you can try a whole life. If that one gets a decline, then we can go to accidental. Now, accidental policies only pay out if you die of an accident. So what's the difference of full coverage and accidental? There's only two ways that we can pass away. One's of an injury, which is an accident, car crashes, stuff you see in the news, got shot, choked on food, storm killed you, dog bit you, you got a bad fight, whatever the case may be. That's an accident. It's from an injury, right? The other way we can pass away is of a disease, heart attack, cancer, stroke, COVID, right? These are all disease deaths. Now, full coverage, like a term and whole life, those pay out no matter what death it is. An accidental policy only pays out if there's an accidental death from an injury. So if you die, if you had an accidental and you had a heart attack or cancer, it's not going to pay out. So there's one more category. So we got injuries, we got diseases. The other category is very risky stuff. So accidentals are not going to pay out if you put yourself in harm's way, like drinking and driving, not an accident. Skydiving solo, not an accident. Tandem's okay. Solo, not an accident. Doing extreme sports, like you're being Shaun White and trying to do a triple axel backflip in a competition, not an accident anymore, okay? Rock climbing, not an accident. Full coverage, any death at all, you're covered, okay? Now, obviously, you guys all remember from our test that there's a 2-year suicide clause that you can't get a full coverage policy and kill yourself in 2 years. But after 2 years and you killed yourself, they count that as a disease. It's a mental health disease, right? So that's a disease, something going on with your brain that's making you not want to live anymore, okay? So it still counts for full coverage, but there's a 2-year clause on that. Okay, any questions on the difference between full coverage and accidental?
What if they're a passenger on the plane?
That's an accident. You died of an injury, right? If you had a heart attack right as the plane was going down and then it crashed and they could figure out that you had the heart attack was the cause of the death that split second before it crashed, technically it was from a disease, right? But probably hard to prove, Yeah. But yeah, that's obviously from an injury, right? So planes would be accidents. Great question. COVID would be natural causes, okay? So I think we want to start with people with term, and usually term is going to be cheaper for people 60 and below, right? And then 60 and above, you probably want to go with whole life because term gets too expensive once you're 60 and above, okay? Is that making sense?
Yes.
So we start with term. We're like, okay, this guy's 60 and below. I'm going to try to get him a term. We start Googling our medications, or we can just start filling out an app on America. It's going to tell us if we're declined right away. But we're going to start doing some Google medications and start looking at some cheat sheets and see if we can get the term. If we can't get them a term, then we're going to go with the whole life. Now, obviously, if someone's on 0 medications, what would you probably offer them?
CBO 100.
CBO 100 or any term, right? Because they're healthy, right? So terms are for healthy. Unhealthy is for whole life. Okay, so let's just do some trial runs here, and we'll see if we can figure out some stuff. Okay, we're gonna go to here. You guys see me? Okay.
Yeah.
So we're on our website, fflrush.com. We're gonna go to quote tools, and before we quote it out, we want to see if they can qualify. So we're gonna use these cheat sheets. Now, these are some references here to kind of keep you on, kind of a general thumb of where you might want to try to head based on age. But again, we still have to see if they can qualify. Now, again, if you're too nervous, just start filling out a Marico, app. It's going to tell you after the first signature if they can qualify for term or not, right? If they can't, go with whole life. But generally speaking, if they're between the ages of 18 and 40, usually a 30-year term with money back is going to be a pretty good price point. They can get their money back. They're pretty young still, so it's affordable, and they can get their money back. 40 to 60, a 20-year term. Because now a 30-year term is going to get kind of too expensive because it's carrying it out too long to those older years. And so it's too expensive. So a 20-year term is kind of the right price point. The money back is also pretty expensive at this point. So maybe do a no money back to get the price point right. Now, if you have someone that has a ton of money, likes the idea of getting money back, you can offer return of premium up to age 50 on most policies, on most terms, okay? So if you think they can afford it, go ahead and offer it, but usually the price point gets a little kind of crazy with money back past the age 40, 45, somewhere in there. it's kind of too expensive. You're gonna have people going, oh, whoa, that's too expensive. So you kind of want to get rid of the money back thing between this age. 60 to 80, generally speaking, probably go with whole life because terms just get pretty expensive at that point. You're gonna have a lot of people kind of, I don't know. Now, if you have someone that's perfectly healthy and they're 65 and they can qualify for a term and they're saying they want term, see if you can get them qualified for a term. Okay. There is, some companies that go up till age 75 for a term. You can still get it in place. Maybe it's like a 10-year term or something like that, but terms are available for healthy older people, but usually the price point's too expensive. And the way we want to think of a term policy is not that price isn't how old we are when we get it that defines the price. It's how long is that locked into, right? So if I get a term policy that's when I'm 50 years old, and I want to have it go to protect me till I'm 60, there's pretty good odds I'm going to outlive 60, right? So they can give it to me cheap. Now, if I'm going from 50 to 80, what do you think the odds are that I'm outlive 80? Maybe 1 out of 3, right? 1 out of 3 odds that I outlive 80, maybe 2 out of 3, I don't know. But the insurance companies, they go, well, we kind of think that 50% of these people are probably going to die. So I need to charge a lot more money to make sure I don't lose some money, right? So think of terms as not when you start them, it's how long they go till. You can explain that to your client, say, hey, I know that term when you were 25 was super cheap, but it was only protecting you till you're 45. Now you're 60 and you want to protect you till you're 80. There's a lot more risk for the insurance company. So they're going to have to charge you a lot more money. And now you take the risk of outliving that term, and that $300 a month you're paying for your policy, they get to keep because you outlived it and you don't have anything back and that money's gone, right? Versus if I put them in a whole life policy, now I know that all the money they paid into it, it's going to last forever. It's never going to expire, and they're guaranteed to get some sort of money paid out to their family tax-free. So that's why I like, 16 above, I'd rather put them in a guaranteed policy. So they're not in a situation where they just spent $50,000 on a term and now they don't have any coverage and they're 81 and they're screwed, right? Rather than put some money that's guaranteed to come back to the family. So that's why I think, pretty much 65 plus, you probably should go with a whole life. Accidentals, if they can't qualify, there's no medical questions on accidentals. So as long as they're 70 and below, no matter what their medical conditions are, they can qualify for an accidental policy. Okay. Now, accidentals are also good for add-ons. Let's just say I wrote them a term. Hey, did you know you qualify for this extra $250,000 or $500,000 accidental policy? The $250,000 is $35 and the $500,000 is $65. Which one did you want to add on? Right. So you can add these onto policies, or if they're declined on both, a whole life and a term, then we have to go with accidental. Okay. So let's just say the client said, okay, so you got all the information, you found out their height and weight. It was 5'7", and their weight is 320 pounds. And they're taking lisinopril, amlodipine, and simvastatin. So what we're going to do is we're going to go to Google. We're going to open up a Google thing here. And we're going to look it up. Lisinopril. All right, lisinopril, what's it used for? Treated for high blood pressure. Okay, so we got lisinopril is high blood pressure. And let's look up amlodipine. We're going to Google amlodipine. And the nice thing is, even if you don't spell it right, it's going to find it, because that's what Google is kind of nice about. Amlodipine, looks like supply blood to the heart. Let's keep going. Amlodipine is used to treat high blood pressure. Okay, so blood pressure, we got another blood pressure here. All right, let's look up simvastatin. Simvastatin. What's this one used for? Simvastatin. Cholesterol. Okay, it's good for cholesterol. So controls cholesterol. Okay, cholesterol. All right, so now we got our 3 medications. We got 2 high blood pressure pills and 1 cholesterol pill. Now we're going to go back to our quote cheat sheets and we're going to look at our term, right? The guy's, let's say he is 55 years old. 55. So I'm going to go to my term cheat sheets. I'm going to look up hypertension. Blood pressure is hypertension. So if I go to blood pressure, I'm not going to see any blood pressure. Just remember hypertension is for blood pressure. So scroll down to my terms, hypertension. High blood pressure actually does high blood pressure. There you go. Instead of blood pressure under B's, it's under H, high blood pressure. All right. Says diagnosed prior to age 30. He said he started taking his blood pressure meds at 40 years old. So we're good there. Taking 3 or more. Nope, he's only taken 2. So we're good there. He hasn't had an abnormal EKG and he started taking these more than 4 months ago. So we know that he's good to go with a term on the blood pressure so far, right?
Yeah.
Now, Alberto, what if he was taking 4 blood pressure pills? Would he be good to go on the Americo term?
No, that's a decline at that point.
Decline, yep. And that's pretty much the same for any term. This one says controlled accepted, John Hancock controlled. But basically what controlled means is if you're taking 2 or less medications. If you need to take 3 or more medications to control your blood pressure, it's not really controlled because you need 3 of them just to control your blood pressure. So think 2 or less on blood pressure, that's controlled, 3 or more uncontrolled. Does that make sense?
Yep.
It does. Would you call the carrier to confirm what they accept as controlled?
You can, yeah. I mean, you can call the carriers anytime you want. I mean, they're there to help you. You can even do risk assessments with the carriers.
Mm-hmm.
So, call those guys often. Any product knowledge you want to do risk assessments. They have a whole team of people there to help you out. You got your mentors, you got videos, you got the million resources. You just have to reach out and use them. But yeah, all the carriers are there to help you out as well.
Okay.
So I'm not sure on John Hancock where it says controlled accepted, but at least in my experience, if you're having to take 3 or more medications for a condition, that's technically being counted as uncontrolled because you need 3 just to control that condition. Okay. So John Hancock, we'd have to call and kind of figure it out. But typically usually when people are on 3 or more medications of blood pressure, they usually have a bunch of other medications too that knock them out of term typically. Okay. So that's that. Now let's go look up cholesterol. Remember we looked up simvastatin, it said for cholesterol. Anytime you see statin, that's always a cholesterol med. So remember statins are cholesterol, atorvastatin, simvastatin, all kinds of statins, those are cholesterol. So let's look up cholesterol. Cholesterol. And cholesterol's probably not on here. Okay, so it's not on the term, cholesterol's not on here. The reason being is cholesterol is not a big deal. So cholesterol is good for everything. A lot of people are on cholesterol, don't worry about it. You're not going to find cholesterol on here, so we're good to go. All right, now remember his weight. He was 5'7" and 320. 5'7" and 320. So we're going down the weight charts now. We got to make sure we check our weight. All right, 5'7", 320. Can he qualify for this?
No.
No, the max weight's 271. So he's out. So let's go look at a whole life policy. And we're like, dang it, he can't get that now. Let me see if he can get a whole life policy. So I'm going to check the weight charts on the whole life. All right, so we're going to scroll down to the weight charts. We know he's good on blood pressure and cholesterol. It's only a med, so we don't need to check this stuff anymore because if he's good for term, he can definitely qualify for whole life. Because remember, whole life is for unhealthy people. So we're good to go on his health for that. We just got to check the weight charts now. All right, so we said 5'7", 320. Oh, overweight for that one too. Dang it. So he can't get the miracle whole life either. What could he qualify for? Oh, whoa. Check this out. Aetna, no height and weight charts. Ba-boom. We can qualify for whole life. There's no height and weight charts for Aetna. That's pretty cool. So we know we can go now with the Aetna. And we can tell them the truth. Hey, your bill's a little bit too high to qualify for term. We're not going to qualify for it. So we're going to have to go with a whole life policy. Remember, we always want to give them full coverage first, right? So we start with the term, then we try whole life, accidental as a last result. So we can get him at least something if he's too unhealthy. So he can qualify because of his weight for Aetna because there's no height or weight charts. Is that making sense?
Yep.
Yeah, definitely.
Okay. So that's the kind of good thing about Aetna is there's no height and weight. All right, so let's go back. Now let's add some stuff. Let's keep the same guy, 55 years old. It's kind of right in the middle. You don't know if we're going to go whole life. We know we're going to go term. We're going to try to get him a term. We're going to see. Now let's add Humulin. He says, oh, I forgot a medication I'm taking, Humulin. And you always want to tell your client before you start asking medical questions, you want to mention this to him. You want to say, hey, the way that we get you approved is they're going to check your prescriptions. They're going to see every single prescription that's ever been sent to the pharmacy, regardless if you picked it up or regardless if you take it, they're going to see that the doctor sent that prescription to that pharmacy. That's what they see. So you don't tell me the ones you're just taking and, oh, I got this prescription, I just don't take it. They're still going to see it. So what would show up on your prescription record at the pharmacy that you're taking currently, even if you take it or not, or even if you didn't pick it up, what are you currently seeing? He goes, oh, you know what? Humulin's one I forgot, Humulin. So you want to make sure they're clear, like, hey, they're going to check this stuff. You need to be honest with me about this stuff so I can put you in the plan that most likely will get approved. We have to get approved first. So now let's look up Humulin. Let's go look up Humulin. All right, so we're going to close these down. Let's go Humulin. Humulin. And if you don't get the spelling exact, don't worry about it. Oh, looks like Humulin's insulin. All right, insulin. So shoot, now we got insulin. Okay, so we're gonna go back to our cheat sheets. And let's just say this time that he's within the weight charts. We'll say 5'7" and 200 pounds. Okay, 5'7", 200 pounds. So now we're gonna go to the cheat sheets. We're gonna go to term. We're gonna try to get him term first, right? And let's scroll down to insulin. All right. Oh, where's insulin at here? Oh, it's probably under diabetes. Scroll down up to D's. D for diabetes. Diabetes, okay. Well, diagnosed last 6 months? No. Diabetic phase 35? No. Prescribed using insulin, decline. We got to decline on terms. We can't go term now, right? Decline on this one. Diagnosed before age 50. Again, any insulin is usually a decline on every term. So keep that in mind. This chart isn't exactly accurate, but pretty close. John Hancock, keep in mind, insulin prior to age 40. This should be 40. So keep in mind, this is an error. So as long as he took insulin, he started taking insulin after the age of 40, I could get him a John Hancock. Because he started taking it after age 40. Now, if he started taking insulin before age 40, then he would be a decline. But this is an error, it's 40. So I found that out the hard way. Now, let's just say he started taking, diabetes pills, which is metformin. Okay, let's say he took metformin at age 25, and then he started taking insulin at age 50. He would be approved on John Hancock because this is the only thing that they have is if there's complications with diabetes or insulin prior to age 40, decline. Other than that, you can go John Hancock. So that's a really good one. If you have some people that are older that are on some insulin, you can still get them approved as long as they start taking insulin after age 40. Is that making sense?
Yeah. Yep. Even combination with the pill.
Yep. Even combination of pill, because this has nothing, it says nothing about pill. It just says complications. So the only major complication that you're going to find with diabetes is diabetic neuropathy. And the pill that you're going to see people take is gabapentin. So let's just, for example, let's go look at the weight charts real quick. So let's just say he was just taking insulin. He started taking it at age 50. We're going to scroll down to the weight chart now to John Hancock. And we're going to see that he's 5'7" and 268 is the max weight, and he's 200 pounds. So we know we can go with a term. We're good to go now. Okay. So let's add in 2 more. Let's say usually people on insulin are usually on the most common medication is going to be metformin. So let's Google metformin. You're going to run into this one all the time. This is a pill form. It's for type 2 diabetes. And just know that it's for diabetes. Control high blood sugar. So for diabetes is used for patients with type 2 diabetes. Okay. So metformin, then let's add in, this is the tricky one. This is the one that messes up. This only real major tricky one here is gabapentin. Let's see what gabapentin's for. Gabapentin treats seizures, decreasing excitement in the brain, shingles, restless leg syndrome. It can do a lot of stuff. So it can control a lot of things, but keep in mind that if they're taking diabetes medications, any diabetes at all, and if we go look at this cheat sheet back to protecting a family, we scroll down here. Here's some underwriting tips. If someone has diabetes and is taking gabapentin, every insurance carrier will automatically take that as a diabetic complication, diabetic neuropathy, regardless if they tag gabapentin for diabetes complications or not. It's a tricky one, so try to remember that. Okay, so now let's just say someone's only taking gabapentin and they have no diabetes problems. Do you think they'd have any problem on term?
No.
They wouldn't. No, it's fine. So only if it's that combination, diabetes plus gabapentin, take it as diabetic neuropathy, which is a diabetic complication. Okay, so let's now add in, let's just say he takes insulin and he takes gabapentin and he takes metformin. Metformin is the pill form for diabetes, insulin is the liquid form. And now we know he has gabapentin, and we're like, he's like, no, I just take it for nerve pain. It has nothing to do with neuropathy. Well, let's go look at the cheat sheets. Let's go look at cheat sheets and go look at term again. And we go down to diabetes. And we were trying to get him a John Hancock, right? Diabetes, where's diabetes at? There we go. Any complications of diabetes decline. So they're going to take that as a complication. So now we can't go with a term. So now I have to go back and go, okay, term's out. Let me try a whole life. So now I'm going to try a whole life policy. And we're going to go down and look at diabetes, complications, diabetes complications. And complications, this says here, insulin shock, coma, retinopathy with something to do with your eyes, nephropathy, I think that's kidneys, and neuropathies where you have tingling in your extremities, like your legs, your foot, stuff like that. It's where you lose a toe. Okay, so neuropathy. So it says any complications at all within 2 years, it's guaranteed. So if he's taking gabapentin plus a diabetic medication, they're going to count that as a diabetic complication, neuropathy. So this is a guaranteed issue, which means it's not immediate coverage. We got amputation, decline, neuropathy, modified, which means you're not getting the best rate, modified. Complications, return of premiums, they're modified. They're all declined, okay, or all graded. So the only carriers that can take gabapentin and a diabetes medications, Royal Neighbors. So I want you guys to focus on Royal Neighbors. If you guys don't have Royal Neighbors, you guys can ask for it, and we'll get you appointed with Royal Neighbors. Okay. Any questions on this so far, guys?
No.
Nope.
Yeah. So we go with term first, younger and healthy. They can't qualify whole life next, can't qualify accidental third. Okay. And we can start off with just Americo policies. We don't have to overthink it. Americo. Start off with Americo. Americo's great because when we start filling out the app, it's going to tell us if they're approved or declined before we get to the payment page or anything else. We can just fill that out, see if they're qualified, and that's kind of an easy way to do it. Let's just say they're taking Spiriva. You're like, what is Spiriva? Let's look up that one. Well, let's start with ProAir. So we'll start with ProAir. So we'll go ProAir. It's a pretty common one. ProAir. ProAir is an inhaler. It's like albuterol. Okay, so albuterol is for like albuterol. Anytime you see albuterol, that's usually asthma. It's for asthma stuff. So asthma is okay. But what if I'm taking more of a serious medication like Spiriva? Spiriva. I look up Spiriva. It says asthma and COPD treatment. So anytime you see a medication that says COPD, then that means they're most likely taking it for COPD. If it's just asthma, typically they're just taking albuterol. There's a lot of different name brands for it, like ProAir and a couple other ones out there. So look up albuterol, asthma. Anything else, most likely COPD. So let's go to our cheat sheets here. And let's look up, remember a term. Let's say we're trying to get this guy a term. And he's taking COPD med, okay. Spiriva for COPD. Oh, decline. Okay, so you can't get a term. What am I going to try next? Come on, guys. If you can't get
Whole life,
right? So now I'm like, okay, can't get whole life. Now I'm going to go check my whole life cheat sheets. He's taking a medication for COPD. Now think about this. The underwriters don't have a lot to go off of. So if you see a medication like Spiriva and it says can be taken for albuterol or COPD, they're probably going to count the worst condition, right? They're like probably taking for COPD. I'm not going to take the risk here, right? Yeah. So, for you guys, take your time with underwriting. If you're not sure how they're going to take the worst possible situation and go that route. That way you're writing stuff that's 100% going to be guaranteed to get approved so you can get paid and the client can get a policy, right? Because if you're writing someone a term and it gets declined, trying to convince them to get a whole life now is going to be pretty difficult, right? So if you're not sure, go whole life. But let's go look up COPD. COPD, guaranteed issue, which means it's a 2-year waiting period. That one's out. Standard, graded, ROP, standard, graded. So which one do you think I should write out of these ones?
Foresters.
You can write a Foresters one or
Aetna.
Or an Aetna one. Yep. Guaranteed issue, graded, ROP, graded. This all means the rates are going way up and it's a 2-year waiting period. Standards, immediate coverage, just immediate coverage. So we're going to go with Aetna or Foresters for COPD. And here's another little quick cheat sheet. It says on the term cheat sheet, if it says decline, offer accidental. If not, ask right term. Like I said, if they're older, we can go with whole life next. On a whole life cheat sheet, if it says guaranteed, ROP, modified, or graded, you can offer an accidental. If it says preferred, standard, not asked, or immediate, you can write the whole life. So these words, guaranteed, ROP, modified, or graded, they all mean the same thing. It just means there's a 2-year waiting period, and it means the rate for the coverage went up quite a bit. Okay. So if you see
would you prefer to write the accidental than a guaranteed or modified whole life?
It depends. If you're writing a final expense product, which is there to cover funeral costs, then you always have to go with whole life. So if you have to write it guaranteed, RP, modified, they go that route. If you're writing life insurance or mortgage protection, then I would go with an accidental.
Okay.
Then get them more coverage in case they die, right? So it depends on what kind of policy I'm trying to write. Usually on the elderly people, you might want to go the whole life, just their health's probably not going to get better. Might as well get something, have that 2-year waiting period. If someone a little bit younger, I'm probably gonna write them accidental, see if their health gets better, and then try to reapply down the road. A good example is like if someone had a heart attack, right? So let's go look at like heart attacks. Say I had someone's like, yeah, I had a heart attack 6 months ago. And I go up and look at heart attacks. Scroll down to heart attacks. And this is on a whole life policy. Where did that be at? H, heart attack. So it's within 1 year guaranteed, within 1 year modified, within 2 years modified, within 2 years ROP, within 1 year basic, within 2 years standard, within 1 year decline, graded. So they all are going to be graded. But if I go, hey, I'm going to start you an accidental because it only happened 6 months ago. Something happens in the next 6 months, you're going to get a lot of money for a cheap price. And then after the 6-month period, we can reapply for a Miracle Eagle, and then we can get you a better rate. So that might be a good example. I start with an accidental and follow up with him once he's past that year point, and I can get him a better rate. Does that make sense?
Yes.
Is that making sense, Alberto?
Yep.
Okay. Let's look up some more medications. Wellbutrin. Say I have a guy with Wellbutrin. Wellbutrin. Says it's an antidepressant. So we're going to go back to FFL Rush. And we got depression. Let's go look. We're going to try to get him on a term. Maybe he's 55. So we're in cheat sheets. Go term. Depression. Let's find depression. Depression. Major depression, chronic depression, or bipolar declined. Mild or situation depression, diagnosed last 6 months, or been hospitalized, declined. So you're like, you ask the guy as you're doing your, hey, when will you decline? When would you start this medication? He said 4 months ago. Can he get approved on this plan through America?
No.
No, he can't because it's been 6 months. What about on this one? Can he get approved if it was 4 months ago?
Yes.
He can. This one he can get approved too. This one he can get approved as well. This one he can too. So America's the only one he couldn't get approved on. So I might go with Mutual of Omaha term, might go with John Hancock term, American Amicable term. It just can't be bipolar. Bipolar is declined on all terms. Schizophrenia, major depression, those are all declined on terms. But just regular old depression, you're good to go. Okay.
What would be a major or mild depression difference?
If they're just taking like 2 depression medications, you're fine. But you look up one for like, and it says schizophrenia, or it can be used for a bipolar, then that's like extreme depression, right? Okay. So those are the ones you want to avoid because sometimes those conditions can cause suicide. And so you'd like, okay, let's just say it was for bipolar. Then I'm going to go to, I'm like, okay, term's out. Can't do term. Now I want to go to whole life, right? So I'm going to click on the whole life plan. Let me get this thing over here. And I'm going to go look up bipolar. Let's look up bipolar on this one. Bipolar. Oh, look, not asked. Oh, this one's graded though. So we can't do prosperity whole life. It looks like Americo's good. Aetna's good to go. Senior choice with American Amical's good. You got Forrester's is good to go. Within 4 years graded. So if they had bipolar and they started 4 years ago, they can't do Mutual of Omaha Living Promise. Okay. So the steps. Is this kind of making sense a little bit now?
100%.
Yeah. All we're going to do, we're going to go back to this training real quick of what to write. And let's kind of do a review. Let's read it together and make sure this makes sense here. So what to write. At first, I recommend you guys just start with Americo. If you can't get a hold of a manager and you're feeling stressed out, you think they're pretty healthy, start with a term, and then it's going to tell you when you fill out the first page if it's declined. It's just automatically going to tell you. It's going to give you the medical questions you ask and say, hey, decline. So it's going to do a prescription check real quick. Decline, you obviously go to whole life next. If you want to do it the right way, then look at the cheat sheets. But start with your terms. You can do, if they're 18 to 40, try a 30-year term with money back. If you want to go with Americo, it's called the CB 100. Age 40 to 60, try a 20-year term, no money back. Start with the product Americo term 125. If they're between 60 and 80, maybe try to go with a whole life. Americo Eagle is a good one to go with. If they don't qualify for whole or term, start with an accidental policy. Start with an accidental policy or just get them. As long as they're 70 and below, they have to be between the ages of 18 and 70. So how do we figure out how to qualify them? What prescriptions do you take? Make sure they're honest. Write down the names. Google the medication names. Find out what the conditions are used for. Always Google it. Don't trust the client. A lot of times they tell you wrong information. They're like, oh, it's just mild depression or anxiety. You look it up, it's for schizophrenia. You're like, what? Oh, it's a blood pressure pill. And you look it up, it's for congestive heart failure. Congestive heart failure is a decline on pretty much all the whole lives too. Okay. Big things that you're going to get declines for: Alzheimer's, you got to go accidental. Oxygen, got to go accidental. Terms, if they're on disability, a lot of declines on terms. They can't be disabled collecting disability for terms. Congestive heart failure, that's gone. Cancer, right? Cancer, obviously, you're out on all the policies, right? You can go accidental, or you can go with there is one product. I mean, there's guaranteed products like AIG is a whole life policy that even if you're on your deathbed, there's no medical questions and you can write an AIG. It's available from 80 and below. You guys only get paid about 50% commission on it. So you don't get paid a lot, but at least you can write a whole life on someone that's really sick. Okay. So we Google the medications. We ask the medical background questions. Okay. Which are on these forms right here. Do you have COVID last 10 years? Any blood pressure, heart attack, stent, congestive heart failure, bypass, pacemaker, regular heartbeat, angina, cancer, stroke, oxygen, inhaler, asthma, COPD, diabetes, insulin, diabetic neuropathy, HIV, AIDS, liver disease, kidney disease, hepatitis C, lupus, bipolar. you're gonna read all these out, and then once they have one of these conditions, and you're gonna Google the meds, that's gonna tell you conditions. You're gonna ask those medical questions, that's gonna tell you the conditions. You're gonna ask about surgeries, which are gonna tell you the conditions, and then you look up all that stuff on your cheat sheets. Okay, you can start with the term first. If it's a decline, you can try to go whole life, or you can obviously go to accidental. Right? On the whole life one, if it says guaranteed RRP modified or graded, you can offer out an accidental unless it's a final expense. Then you got to offer one of these or go with AIG, which is a guaranteed issue product. It says preferred, standard, not asked, or immediate, go whole life. Okay. Now on the whole life cheat sheets, if it says guaranteed RRP graded or modified, then all these terms essentially mean the same thing. Different carriers, for some reasons, have different terms they use for rating classes, but they all mean the same thing. Confusing? I know, I get it. I wish they just said they're all called like graded. Be great, but for some reason, Americo calls theirs guaranteed. For some reason, American Amicable calls their graded ROP. Some people call it modified, like Foresters, but they all mean the same thing. It just means there's a 2-year waiting period. So if the client dies of natural causes in the first 2 years, the death benefit will not pay out, but it will pay out if they die of an accident. So let's just say I got someone that's on oxygen, an AIG policy, and they died in a car crash the next month. Would they get paid out the full death benefit amount?
Yes.
Okay, let's just say a year and a half into it, they die of a heart attack. What's going to happen?
Don't
Get the
get
premiums back.
They'll get all the premiums back. We return to the beneficiary plus 10% interest. Now, can you get 10% interest in the stock market? If you're lucky, right?
They claim you can.
If you can't, you don't know, right? But this is guaranteed 10% interest. What if they put their money like, I don't need this policy. I'm too unhealthy. I'm gonna save myself and put it in a savings account. What's a savings account get? What, 0.05%?
Yes.
So this is still better than saving your own money, right? They can put it in an account. If they happen to die of natural causes in 2 years, they get 10% on their money. They get all their money back plus 10%. That's better than a stock market, CD, putting it in a savings account, anything else. So if they're really unhealthy, the guaranteed products are good, but they're just more expensive. And you have to tell your client that, hey, you waited too long. You can keep procrastinating and then not have an option at all. Now you're still going to have the chance to get 10% of your money. And then after 2 years, you get the full death benefit. So still pretty good. Now, remember, guaranteed ROP graded or modified policies, they do pay us less commission. So we want to avoid writing them. Sometimes 30 to 50% less commission. The only company that doesn't pay us less commission on a graded product is Aetna. So if you have to write a graded product, go with Aetna because it pays you full commission. Okay. Underwriting tips, like we said, diabetes with gabapentin, take it as diabetic neuropathy. It's going to be a diabetic complication. On Americo, they do not like pain pills. So if anyone's ever taken oxycodone or any of that kind of stuff for over 2 weeks, try to avoid Americo. They're going to decline it. They say in their underwriting guides, it has to be for over 6 months, but I've seen like someone just take it for 3 weeks and get declined. So just try to go with another term company because Mutual of Omaha is okay with oxycodones for their terms. Americo is not. Okay. So that's it. Go to your quote. Then once you figure out what you can write, then you go to quote it out. Pick which one you want. Start giving them some options. Okay. Any questions on this stuff? Can this make a lot more sense now that we got kind of like a longer video on it?
Absolutely. And just to make sure, you said if we have to go graded, go with Aetna.
Aetna, I mean, Aetna is a lot more expensive than AIG pricing wise. So, I mean, you're going to get the client a better deal on AIG, but it's going to pay you 50% commission plus your Aetna pays full comp. So whatever your top comp is, Aetna pays the full comp on their graded product. So it's up to you. I mean, I try, if I can go to Aetna, I can help more clients that way because I'm going to get paid more money to buy more leads and service more families. But, if it's their budget's really tight, you want to save them a little bit of money, then go AIG. But sometimes, on their graded products on Aetna, no matter, like if they have cancer, you can't get them a graded product. Okay, AIG approves everybody, 0 medical questions. So with Aetna, there still is questions they have to pass to get their graded product. But you can check Aetna first. If it's declined on that one, you check the medical questions and like, hey, so let's go look at it real quick. Let's go look at the quote sheets. What would decline Aetna, completely decline it where you can't even get it? So we're gonna go to whole life and we can look at it real quick. So we go to Aetna, AIDS. So AIDS, we can't, I have to share it, screen share. Yeah, hold on, screen share. All right, so we're looking at Aetna right now. We can see it's declined on AIDS. Right, it's declined for Lou Gehrig's disease, Alzheimer's decline, long-term care decline. So you can just look at this, right? Decline for bone marrow transplants. So there's some stuff you can't write a graded policy on. And then some of them you can. This says modified. So cirrhosis of the liver, you can get them a modified, get paid full commission on it. Let's go look at some more. A DUI within 2 years. Interesting. That's modified. Heart attack within 1 year. So that guy that had a heart attack 6 months ago, you can do a modified product, which is like a graded, like a 2-year waiting period, and you get full commission on it.
Here's a question. When do you figure out that modified premium?
It tells you right here. So when you price it, it lets you price preferred, standard, or modified, or graded.
Okay, so within
the price,
the app, you put okay. So you don't wait until you're in it. You do
select the pricing. Yeah, so that's why you want to use these cheat sheets if you want to give them the accurate price.
Gotcha. Okay.
So what a lot of people do, I mean, if you're brand new and you just are freaking out, you're like, I don't know what to do. Just start with Americo and just go, hey, I'm going to see what you can qualify for first. Start filling out the Americo app on the term. And within a second, after you fill out that first signature process, it's going to kick back and tell you may qualify, which means they probably are going to qualify for it, or declined. And then you can switch right away to the Americo whole life, start filling that one out. If it says decline, then go to accidental. I mean, that's the simplest way to just, if you just are really stressed out about it. But honestly, if you just start Googling the meds and looking at writing down, first what the medications are for, and then second, any health conditions they have after you ask those medical questions, like do they have HIV or do they have a heart attack, write that stuff down, then write down their surgeries, and then start looking at your cheat sheets and finding all those things. You're going to be able, it's going to tell you right there if it's declined or not.
Cool.
Okay. Does that make sense, guys?
Yeah.
Does this help a lot?
Yes,
Yeah.
a lot.
All right, guys.
Accidentals usually mutual Omaha.
Accidental, usually mutual of Omaha. Yep, because it's one that goes all the way to age 70, and a lot of them only go to age 60. And it has return of premium up to age 50. So if they're 50 and below, and you're writing an accidental, it's state specific. Like there's some states like Connecticut doesn't offer it, but a lot of states do. Like Louisiana offers it, New Hampshire, Arizona, a bunch of them. But if they have the option and they're 50 below and you're going accidental, always have to offer the return of premium for 2 reasons. 1, it increases the premium so you get paid more. And 2, makes it a no-brainer policy because they get their money back if nothing happens, which makes it free, right?
Up to 70 with mutual.
You can write it up to 70, but return of premium is only available up to age 50.
With the accidental?
With the accidental.
Okay.
Return of premium up to age 50, available to age 70.
Oh yeah, sorry, that's what I meant. So that's whenever you would get the return of premium at 70.
You would return of premium is always 30 years. So if they got it at age 50, they get all their money back at age 80. If they got it at age 40, they get it back at age 70. So return of premium is always 30 years on the mutual home accidental.
Okay, so just always at 30 years.
Always at 30 years for return of premium. Yep, you got it. All right, guys, hope this helps. Thanks.